Hello, students. My name is Dr. Neeraj, and today I welcome back all of you to my channel so that I can continue with this chapter. This is the second part of chapter 4. We discussed about principle of insurable interest. In the last class, when I was taking this particular principle, uh, many of the students are not able to understand how to find. Theoretically, it's okay what I explained in the last lecture, but when I give an example to the students, they are not able to understand whether there is insurable interest or not. So I just want to tell you again about insurable interest. To find out whether the insurable interest is there for a person to take insurance, you have to, in most of the cases, if that thing is not there with that person, he should get some financial loss. If he gets financial loss, we can say that there is insurable interest for that person. For example, for a person, if his house is burned, there is going to be a loss to him. That means he has insurable interest in that property. But same example with different idea, if that particular person, if he takes into reference of neighbor's house or a person who is not known to him, his house, and his house is on fire, there is no financial loss which will be borne by this person. So because now there is no financial loss, we cannot say that there is an insurable interest on that particular neighbor's property for this person. So when there is no insurable interest, the insurance company will underwrite this as a non-acceptable risk because it can be used in a wrong way. The person can burn the house of the neighbor and he can, uh, get advantage of that. Similarly, when a person is taking insurance for his wife, for his children, there is insurable interest because he has spent some money on them, and if they are no more, there will be a financial loss to them. But this same person cannot insure a beggar or an unknown person because if he dies, if the beggar dies, there is no financial loss on him. Because of that, we can say that there is no insurable interest of this person on the beggar because he is not going to have any financial loss. So this is the concept of insurable interest. And if there is no insurable interest proven, then insurance company will never give policy. Similarly, insurable interest also see the extent of cover. Extent means husband or any person is having a salary of say $100. We cannot say that he is earning $100, but we will give him $1 million insurance policy. There is no insurable interest in that kind of amount. He may commit suicide, he may do something, that means there is something wrong in this particular policy. When he is earning $100, then how he is taking $1 million policy? So, insurable interest also limits this, that how much is his financial capacity, as per that he will be given the policy sum assured. So, like for example, a brother and sister have no insurable interest. Siblings are having no insurable interest in each other. Husband and wife, in some countries, husband can take only 50% of the insurance what he has, not more than that. So these are some of the interesting concepts of insurable interest. Then I also discuss about principle of utmost good faith, which is about faith. When the insurance company is giving insurance to a person, to the insured, it is asking for some declaration, some information on the basis of which they will underwrite or they will give the policy. They will take the risk. So if that information should be correct, if that information is wrong, then there is a breach of utmost good faith. Similarly, the insurer is also on faith, will give the claim on time. Principle of indemnity, again, it is a very important principle which says that insurance cannot be used for profit. It can be only used for recovering the loss. So, this is also important because if it is used for profit, then the logic of insurance is gone. The principle of indemnity is a principle which divides life insurance from general insurance. Yeah. The life insurance does not follow principle of indemnity, but general insurance follows principle of indemnity. Now, for example, health insurance. Health insurance is about a person, it is more related to life. But health insurance is categorized into general insurance. Why? Because health insurance follows principle of indemnity, and anything which follows principle of indemnity is categorized into general insurance. So health insurance is not life insurance. Health insurance is general insurance. Now, this was covered in the last lecture. I wanted to give you some more inputs. Now we are going for principle of subrogation. So, what is principle of subrogation? Let us try to understand. Yep. What is principle of subrogation? Principle of subrogation also has its basis in principle of indemnity. What is principle of indemnity? That loss can be recovered by insurance and it cannot be profit generating instrument. Now, what is principle of subrogation? Like, for example, let us take one. Okay, I will try to open the whiteboard. Now, suppose Mr. X is there. Mr. X is driving a car and he meets with an accident. And the mistake of this accident is all on Mr. Y. Mr. Y has done some mistake. He was going in the wrong direction, or he was drunk, or he was not having license. The mistake was there for Mr. Y. So Mr. X gets a lot of problem and he's hospitalized and his car is damaged. And he spends around 50,000 saber. Okay. Yeah. So let me draw something here. Mr. X is driving in this car and he meets with, again, another car is there. And there is a accident. And this is the car of Mr. X and this is the car of Mr. Y. Whose mistake is it? It is a mistake of Mr. Y. Now, how much is the damage? Damage is 50,000. USD. Insurance company has given this particular 50,000. Say, name of the insurance company is Nile Insurance. And 50,000 is paid by Nile Insurance to Mr. X. Mr. X gets 50,000. Now Mr. X catch hold of Mr. Y because he was at fault, and he again demands, say, another 30,000. 30,000 USD. He is not willing to give 50,000, but he say, okay, I will give you 30,000 USD. Don't drag me in the court and don't create problem for me. Because it is my mistake, I am giving you 30,000 USD. Now here comes the principle of subrogation. Now Mr. X has already got 50,000, and if he gets 30,000 from Mr. Y, his total is 80,000 USD. But how much is his loss? 50. How much is his profit? Because his loss was 50, but he gets 80. A profit of 30,000 he gets, Mr. X, if he is able to get this 30. But what is principle of indemnity? You cannot go beyond losses. Losses are almost 50,000. So Mr. X cannot get the compensation from Mr. Y. He can get compensation from one person, that is Nile Insurance or this person. Obviously, Nile Insurance compensation he will take because it is more. So 50,000 is taken by Mr. X, and then he cannot claim any money from Y. But Nile Insurance, as per principle of subrogation, has a right to reduce its losses because 50,000 is a claim amount which is a loss for Nile Insurance. The Nile Insurance can take this 30,000 and reduce its losses to 20,000. 50 minus 30 is 20. 20 is the net loss of Nile Insurance. So this is called as principle of subrogation. Mr. X cannot take benefit from the third party also and from insurance company also because it will lead to profits. So I hope you have understood what is principle of subrogation. Which is a very simple concept but an important one. Thank you. Next is principle of contribution. What is principle of contribution? Let us take an example. So let me add, if I can. Okay. Let me. Yeah. Okay. Now let us take another example. Let me divide this. Now suppose Mr. X has a health insurance. Health insurance of say 20,000 USD. Now again Mr. Health is admitted to the hospital. And he gets a claim amount, a bill amount from hospital for 20,000 USD. So his loss was to 20,000 and he gets some insured of 20,000 from the Nile Insurance. Nile Insurance again. Policy. Health. So this is from Nile Insurance. Again, he has one more policy. He has one more policy from Ethiopian Insurance. Now the question is, can Mr. X can Mr. X get claim from Nile also and from Ethiopian insurance policy also? Is it possible to get from both? His claim amount is 20,000. He has two policies of health. By the way, health insurance is general insurance and it follows principle of indemnity because it is a general insurance. Now, if he gets from both of them 20,000, 20,000, obviously then there is a profit to him, profit to Mr. X. His loss was 20,000, which was a hospital bill. This is a claim amount, but he gets 40,000 from both. So it is again not following the principle of indemnity, it is generating profit for him. But now the problem is, if Mr. X goes to Ethiopian insurance policy, it will say that go to Nile. If Mr. X go to Nile, Nile will say go to Ethiopian insurance policy. And Mr. X is rotating from here to there. So there is a law for that. If there are two policies beyond the claim amount, then there is something called as principle of contribution. If the sum insured is same, like in this case, both are having sum insured same, then principle of contribution say that it should be 50-50. 10,000 will be paid by Ethiopian and 10,000 by the Nile insurance. This is called as principle of contribution. But suppose the sum insured is different, then how you will calculate the contribution amount of one insurance company? It can be calculated by this particular formula. Okay. Yes. The formula says contribution is equal to contribution of one insurance company is equal to sum insured with the particular insurer. Like for Nile, it is 20,000. So 20,000 will be written. Total sum insured with all the insurers. 20 plus 20 is total 40. 20 by 40 is half. That means half of loss. This proportion will change as per the sum insured. You can easily calculate the contribution. Lesser the sum insured, lesser will be the contribution, obviously, because it is a proportion. So this is called as principle of contribution. Last one is, actually, we'll see the last. Okay, the last is the proximity cause. Principle of proximate cause. What is proximate? Again, let me go back to our blackboard. So what is proximate cause? Let me put again a line. Proximate cause says that insurance company is liable to pay only if the peril covered is proximate cause. That means, what is proximate cause? What is the meaning of proximate cause? It means that it should be active, or it means it should be real. It should start the events of problem. It should start the cause of the problem. That is proximate cause. And that proximate, the one which caused the beginning of the problem, the real problem, active issue, real issue, which started the problem, should be covered by insurance. It should be a direct, immediate effect. It should be primary. It should be the main reason for it, for the cause of the loss. That is called as proximate cause. So why proximate cause is important? Because proximate cause will decide whether the claim is paid or not. Whether the claim will be paid or not, it will decide. Now let us take again Mr. X. Mr. X, okay, let me do some drawing. Yes. Mr. X is having a house. Mr. X house. Now, Mr. X has covered this particular house for, say, fire insurance. Which insurance he is covered? Policy is taken, policy, risk, policy of Mr. X is what? It is fire insurance. Mr. X has taken fire insurance. Now, let us take a case study and decide whether Mr. X will be paid a claim or not. Now, there is an earthquake. Because of the earthquake, there is a leakage in the gas, or electrical connections got connected and there was a spark and the gas got bursted and there was a fire. So, this Mr. X has taken fire insurance from my insurance company. Now, is Nile Insurance entitled or obligated to pay the claim for Mr. X? That is the question, students. Is insurance company going to pay Mr. X in this particular case? What is the case? Mr. X has fire insurance from Nile Insurance Company. He has fire insurance. What happens then? There once upon a time, one fine day, there is an earthquake. Because of earthquake, there is a gas leakage and some electrical connections are loose and there is a spark, and because of the spark, there is a fire in the house and the house is burnt of Mr. X. Now, students, the question can come in the exam whether insurance company will pay the claim. Now, how to go about this particular question? First rule is only if the peril, what is peril? Earthquake and fire in this case is perils. If the peril is identified, first of all you have to identify the perils, and the peril which caused the loss should be insured in the policy. Then only the insurance company will pay to the insured, Mr. X. Now, what are the perils? Fire as well as earthquake. What is the what is covered in this particular case? Fire is covered. Now, fire is covered, but what started the fire? Earthquake started the fire. What is the beginning of the, which started the events? Which is the main cause of the fire? Is it the gas? Is it the wire? No. Is it the spark in the wire? No. The main cause is what? The earthquake. So earthquake is the proximate cause of this particular loss. Is earthquake covered in this policy? It is not covered. So, Nile Insurance Company can deny this particular claim, saying that the proximate cause is not fire. The fire happened because of some other reason, not because of the natural reasons. If there was no earthquake and there was spark and there was some problem in the house by chance, then definitely the claim has to be given. But all this happened because of earthquake, and earthquake is not covered in this particular insurance policy, so the claim will be denied because of the proximate cause. So friends, these all principles are important for you. They are the building blocks of insurance and also underwriting. Underwriting means whether the risk will be covered, whether the claim will be given or not. So all these things are important, I hope you enjoyed this particular lesson. And if you like such content about management, about leadership, motivation, risk, and research, if you like all this and you want to get updates, kindly subscribe to my channel. Thank you very much for watching.